Welcome to another real estate industry update. I'm Daniel Roccanti here with Kyle Paxton.
Hello.
Here at James Moore, we're part of the real estate segment. And so today we're going to kind of talk a little bit more about the basics. Okay. We've touched on, I would say, some more complex issues lately. And since it's tax season, taxes are front of mind. And I was like, let's talk a little bit more about purchasing rental real estate just from a tax perspective, what you need to be looking out for. So some of this might be a little too simple from some of you experienced tax investors out there, but it's always good to get a free refresher, and you'd be surprised sometimes what you would learn.
Sure enough, we like to think we know things and we can share it. So I'll dive into talking about cost basis. So when we're talking about the purchase of property, cost basis and the context of income tax in the world we live in refers to the original value of the property. And that is used to determine depreciation, capital gains on sale, other tax related calculations, maybe some credits, things like that. Generally, all function off of cost basis. At a high level, tax operates on historical cost. So each year, you're not updating the value of your property on your balance sheet, on your tax return, Schedule L. If we're talking a business return to reflect the fair market value, it's going to stick at the original cost basis, less some of these adjustments we have moving forward. So the major components of cost basis, we usually see the purchase price, closing costs, improvements, sometimes assessments factor in, any other acquisition costs, surveys, appraisals, engineering costs, things like that, all get baked into the cost basis of property. For
And it's important to understand what is cost basis, because I feel like this part right here gets overlooked a lot. It's not just the purchase price, it's all those costs associated with acquiring the property. If you look at the closing documents, like the HUD, you'll see the purchase price, and then you'll see all these adjustments, and some are cash items, some are non-cash items, and people are usually just thinking cash related, like how much money did I pay? Well, there was all these adjustments to determine, how to get there, whether it's the closing costs, adjustments of property taxes, adjustments of anything that could be paid by the by the seller or the buyer based on when the purchase happened and in the year. Because like property taxes are usually paid at the end of the year. Okay. So what happens when you sell a property in the middle of the year? Well, property taxes don't get paid to the end of the year. So now we have to allocate what would have been paid if it was split based on when the ownership changed. And so these are all important factors that go into how we actually get to your cost basis. And also, some of this stuff could even be expense, doesn't even have to be allocated into your cost basis.
And we're always looking to kind of optimize that to the extent we can, right? So depending on your tax picture, we take a step back and say, okay, what's required to be capitalized? How can we optimize this for depreciation perspectives and things like that? So those are exercises we go through. We have nice guides that break down a HUD statement into the different line items that factor into cost basis. It's stuff that gets us excited. So on a go forward basis, that cost basis can change. So as you have additional capital improvements that we're unable to expense on the tax returns or you elect to capitalize. Those can be factored into the cost basis on an ongoing basis. And then that can also be decreased. The most common thing we see is depreciation, right? So once you acquire your property, you place it in service. If you're renting it, if you're using it in your business, whatever that looks like, yeah, you can start taking depreciation deductions. By default, you will bifurcate property, your standard property you buy between building and land. The building component, if it's residential, is depreciated 27 and a half years, commercial 39, land is non-depreciable. Then we get all kinds of fun stuff from there that we'll dive into a little bit more. But again, I want to reiterate kind of one more time before we move on here. The big things for cost basis are the driver for that depreciation, ultimately the capital gains that we pay upon disposition of this property. And then another big thing that pops up that is an important consideration here is cost basis is big in estate planning and gifting concepts. And strategies and structuring your transition plans and things like that. Cost basis plays a very important role in that and how you go about structuring those plans and whether some gifting strategies work to help mitigate tax down the line and make your lives easier. Dana, do you have anything to add on that before we dive into depreciation in more detail?
Well, I really want to dive into more of the allocation between land and building. So I think this gets overlooked a lot. From all the deals I do, this really doesn't get touched by most people on the broker side because to them it's like it's all the same. But for tax purposes, it's a big deal. Like Kyle mentioned, you can only depreciate building. Land is non-depreciable. Okay. So when people are investing into real estate, one of the biggest reasons they invest in real estate is the tax benefits. You have a chance where you could potentially front load a lot of losses, purchase of the building basically, to create a tax loss where you didn't really actually create a financial loss. Okay. So when you're trying to do things like that, you want to allocate as little to land as possible and as much to building so you can get that depreciation. But, you know, obviously when you buy land, there is land associated with it. Okay. And so we have to figure out how can we make that allocation happen. All right. Very few cases is there no land when you purchase real estate. This would be like a condo where you're truly buying the building and nothing, and you're not buying the land at all. Okay. Like for most real estate deals, you're buying land and building. So there's a couple ways to basically allocate land. First is you always go look at the closing documents. Okay. If the closing documents spell out how the purchase should be allocated, so let's say it's $1 million deal, and they said 800,000 of it is allocated to the building, 200,000 of it's allocated to land, you have your allocation right there. That makes life easy.
How often do you see that, Daniel?
When I see it, I'm so surprised.
Yeah.
I, I fall out of my chair and go, "Are you serious? Like I've never seen this." But if you are a buyer, you should actually probably be considering when you're doing your closings, talking to your broker. Hey, should we just go ahead and figure out the allocation here? Okay, because now you have control. All right, the more control you have over the allocation, and you can make it more or less. Now it's going to have to still be within somewhat reasons, but you have control. Okay, so let's moving on. Nobody allocates it on the closing documents. The second is an appraisal. All right. So if you get an official appraisal and in the appraisal they allocate the land and the building, then you can also use that. Most people are not getting appraisals or they're not giving them to us, or the appraisal actually does not allocate the land in the building. I've seen that more. They're appraising the total cost, but they're not segregating it. So the appraisal is useless for most standard appraisals that people have to get because of loans and things like that. So the most common way after that the IRS allows us to do it is basically they let us use property tax assessor values. Okay. So we go out to the property appraiser's website. They value, basically give everything a tax value, which that's how they come up with property taxes. Okay. Within that, they allocate the difference between land and building. All right. Because everything could potentially be taxed a little different. Okay. Those actual values will not line up with what your purchase price is. They come up with their own allocations. It's usually significantly lower. That's how you're getting taxed. But what we can use is the percentages. Okay. So say same thing before, they allocate 20% of the value to land. We are going to allocate 20% of that to it. Okay. And just from my expert opinion, from seeing a million of these, usually land is going to be around 20% on those.
Yeah. Almost always.
Almost always. Depending on where you're buying, land could be more valuable. Or if you're buying a building that's basically falling down that needs major rehab, it might not. But you're basically going to get a 20% allocation for land, kind of general, if you go that route. So if you're wanting to basically be more aggressive and say it's a 10%, you need to be doing that on the purchase in the closing documents or getting an appraisal that basically shows that.
All good points. And that allocation drives the depreciation deduction, which is a big ticket item for real estate investors and pretty much what I talk about all day, every day. But the big benefit to one of the reasons why real estate is so beneficial for tax purposes is the depreciation, and then different strategies around depreciation where you can create taxable losses that aren't necessarily tied to cash. For our real estate professionals who can take all of real estate losses have non-passive treatment on their real estate losses, which we have a video for if you haven't seen that. Uh, Daniel, you want to dive into depreciation a little bit deeper?
Yeah, so Kyle went into a little bit over the basics, but to kind of rehash here, the basics are if you buy residential rental property, it appreciates 27 and a half years straight line. If you're buying commercial property, it depreciates 39 years straight line. Okay, straight line, all that means is it depreciates evenly over that time. Okay,
It's a
so
long time.
it's a long time. All right. And while you're getting a deduction and it's a non-cash deduction, it's very nice. It's probably not creating that huge taxable loss that you read about or heard about. And so you're like, I don't get the big deal. Okay. So how do you do that? And basically, to do that, we need to break up the components, okay, into more favorable lives that depreciate over smaller time periods and allow for things such as bonus depreciation. Okay. Bonus depreciation gets talked about a lot. The rules are always changing over it. So, literally when this video comes out, the rules could change between when we produce this video and when it doesn't. But historically, bonus depreciation is usually somewhere between 50% and 100%. Okay. With the Tax Cuts and Jobs Act, it's been 100%. And then it starts slowly going down. And now currently with this video, there's talks about basically making it go back to 100%. Okay.
And that's percentage of that original cost basis allocable to the depreciable asset.
Correct. So
Yeah.
if you don't segregate, what we're going to talk about is a cost segregation here, everything is going to get basically depreciated at 27 and a half or 39-year property. So how do we break it up? Okay. What we do is we call it the cost segregation study. Okay. There are firms out there and people, such as our firm and other firms that are helping a lot of CPAs that can basically produce a cost segregation study. Usually these have to be done by engineers. Okay. So not usually your CPA can't just do it for you. There has to be some kind of formal engineering in there.
Qualified.
Yes, that's a whole story for a different day. But it does have a cost to it, and they produce this study and they provide it to you. But basically, it breaks down that property into all these different components that are different useful lives. So where now, let's say I buy a large commercial property, it's 39 years. It's like, okay, but now I go out there and I get a cost segregation, and now I find out that, okay, 40% of that building is actually 5, 7, and 15-year life property. Okay. And 5, 7, 15-year life property are all eligible for bonus depreciation. And if bonus depreciation is at 100%, I'm writing off 40% of that purchase price plus the extra straight line on the 39 for the other 60% year one that I purchased that property and put it in service. That's how you're creating these huge losses, by accelerating that depreciation that would have took me 20 years, something like that to get. I got it in year one. And so for a lot of people, especially purchasing property of a certain size or more, the cost segregation study is basically what a lot of people are doing to get that accelerated depreciation.
And a couple more things I want to add to that. We're playing with the time value of money here, right? So you get that deduction one day. This is just pulling it forward. And so with our real estate professionals, you play that game of timing this a little bit, right? You have some flexibility when you perform cost segregations, and being strategic around that can significantly reduce your tax bill over time. And so with the IRS, when you feel like something is too good to be true, it usually is, right? So we're creating this depreciation reduction in year one. Ultimately, when you go and exit the project and you sell the underlying property, there's a depreciation recapture component to where you got that deduction in year one. When you go and sell, a portion of that gains tax ordinary rates to recapture that depreciation you got previously. So again, you kind of get into this cycle, right? Where if you're kind of coming in and out of projects, you have year one where you have a deduction, you have year 5 where you have a gain. Now you enter a new project where you have the big deduction in that same year, and you can kind of play with that cycle and keep it going forward, right? Um, and so to Daniel's point, you usually see cost segregations come in 20-40% of the total cost being the tangible personal property or improvements, landscaping, sidewalk, things like that you can accelerate your depreciation on. But these are all kind of sized differently and can translate into different tax savings. But most of the companies that do this, you give them basic facts. They say, here's your cost and here's your tax savings. Take it or leave it. So it's really easy to get into. And then the one other point I want to make on cost segregation is there's a lot of I don't quite know how to put it. We'll call it DIY software solutions for cost segregations that tend to be a lot cheaper than these formal kind of engineer firm driven cost segregations. While possible, I've seen it some on residential, single family residential properties specifically. The IRS scrutiny around those things is higher, and it's much nicer, safer to have that formal kind of report backing these deductions you're taking than some of those other options here.
Yes,
But
there is couple different options on a cost segregation. There's a full study, and then there's these desktops or pocket cost segregations. We're not saying don't use them. Just do your due diligence to make sure that they would basically pass an IRS audit if you do use those.
And so the big point I want to kind of lead this into is from a planning perspective. I think we get clients get burned fairly regularly on, especially new clients that come on board with us, to where they've been taking these depreciation deductions for years. All of a sudden, they have a sale and they get whacked with a big old tax bill because of that depreciation recapture they're not expecting. And then, even through that, not through just removing the federal impact, we've seen a lot of issues come through with state and local tax concepts on the income tax side of, just for instance, you create a large taxable gain here that you may have to withhold a portion of those, the sales proceeds on behalf of your non-resident partners. If you have partners outside of the state, which the underlying property is held, that's triggering that gain. So a lot of fun stuff there that goes from a tax planning perspective. We pay a lot of attention to. We're creating losses with the cost segregation and playing around with those rules, optimizing this depreciation deductions and the timing of them, and then making sure we're positioned well for sale, exit, estate planning, transition type stuff. All of that feeds into the fun and what makes me excited to come to work on any given day.
Yeah. So, I mean, the cost segregation is a great tool, but there does need to be planning around it. Okay. There's a few things you need to consider. What Kyle already kind of mentioned it. First of all, if I'm going to take all these losses, can I actually take them? Rental real estate in its normal form is passive. So it produces passive losses. There's only a couple ways to turn those passive losses into active losses. The most common way is basically real estate professional status. So do I meet real estate professional status? We have a whole entire video that goes into it because it's so complicated. Please go back and watch that video if you're not sure what a real estate professional status is. But if you meet that, then okay, now I can offset other income. If I can't, okay, now it only offsets other passive income. Do I have enough passive income for it to offset? Or is it going to get suspended and just held there? Where it's like, well, what's the point of front loading all these losses if I can't even take
You're
it?
paying for what, right? Yeah.
All right. You're basically paying so that you can't take losses. So you're just creating additional expense for you. Okay. So make sure the ROI is there. Okay. And then second, when we're thinking about ROI is where's your other sources of income? Okay. You want to make sure you're reducing income at the highest taxable rate. Okay. 37%. If I'm making $1 million, well, cost seg plus, cost seg is now very beneficial to me because I can wipe away all that income or a lot of that income at a very high tax bracket, produce a lot of tax savings. But let's say I put this property in service, but that was a bad year for me and I don't really have a lot of income from other sources. I'm going back to the same problem here. Even if I can take the losses, I got no income to take it against, or it's at a very low tax rate. It's probably better to just pay the taxes at that point. So you just want to make sure that if you're doing a cost seg, it makes sense to your situation. And the study can be done after the end of the tax year. So you don't even need to make that decision. Now, the property has to be in service for you to get the depreciation. But let's say you put the property in service in 2024, but you're unsure if you want a cost seg study, you can wait until 2025, get the cost seg study once you know for sure. I will say there's a lot of people doing cost segregation studies in tax season. So if you are going to get one, you either need to make sure you get one up front. Usually there's deadlines for all these people getting cost segregations, or you're going to have to extend your return and wait till after tax season.
All good stuff. You can do cost segregation at any point in the year. So don't wait until you're trying to file your tax return on the deadline. I'm hounding you for your stuff.
But just a quick recap here on some of the key points. When you're buying that property, remember everything the cost to purchase that, not just the purchase price, is now part of the cost basis. Allocating between land and building is very important, and there's different ways you can do it, and having more control to create a more favorable outcome to you. And if you're really looking to take that next level of losses on your rental real estate property, you should look into a cost segregation and plan if that is the right action for you. Thank you for tuning in today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Until then, stay informed, stay proactive, and happy investing.
Thanks for watching.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.